We all know Vagaro as that powerhouse platform that helps you streamline everything from appointments and client management to marketing and point of sale. It's a game changer for many, simplifying the day-to-day grind so you can focus on what you do best, serving your clients and growing your passion. But when it comes to those bigger financial hurdles, the kind that require a significant injection of capital, does Vagaro step up to the plate and offer direct funding solutions? That's what we're diving into today. Before we get to the direct answer, let's set the stage a little. Running a business in the wellness and beauty industry, or any service-based business for that matter, comes with its unique financial ebb and flow. There are peak seasons where revenue is soaring, and then there are quieter periods where you might need to be a bit more strategic with your cash. You might have ambitious plans for renovation, or perhaps you're looking to bring in a new, cutting-edge piece of equipment that will elevate your services and attract more clients. Maybe you're even considering opening a second location. These are all fantastic goals, but they invariably come with a price tag. And sometimes that price tag is bigger than what your current cash reserves can comfortably handle. This is where the idea of a business loan often comes into play. Traditionally, you'd think of banks, credit unions, or perhaps online lenders. These are the usual suspects when you're looking for external funding. They each have their own application processes, eligibility criteria, interest rates, and repayment terms. It can be a lengthy, often complex, and sometimes frustrating journey. You're typically asked for detailed business plans, financial projections, collateral, and a whole lot of paperwork. For busy professionals who are already juggling client schedules, staff management, and inventory, adding a complicated loan application to the mix can feel overwhelming. So, with that context in mind, let's get to the crux of it. Does Vagaro directly offer loans to its users? The straightforward answer, as of my last update, is no. Vagaro itself does not operate as a direct lender, nor do they have a dedicated loan program where they provide capital directly to businesses using their platform. Their core business model revolves around providing the software and tools to manage your operations, not to act as a financial institution. However, that doesn't mean Vagaro is completely disconnected from the world of business financing. In fact, their robust platform can indirectly play a significant role in helping you secure the funding you need from other sources. Think of it this way. Vagaro provides you with a treasure trove of data that traditional lenders love to see. Let's break down how Vagaro can be your silent partner in the loan application process. Firstly, your financial reporting. Vagaro's point-of-sale system and integrated reporting tools give you an incredibly clear and organized view of your revenue, expenses, and overall financial health. Lenders want to see consistent income, a history of strong sales, and a clear understanding of your financial ins and outs. Vagaro makes it easy to pull up reports on daily, weekly, monthly, and annual revenue, client spending habits, and even product sales. This kind of detailed, easily accessible financial data is gold when you're preparing a loan application. Instead of scrambling to put together spreadsheets, you can often generate professional reports directly from your Vagaro dashboard, saving you time and presenting a clear, credible financial picture. Secondly, client management and retention data. Lenders are not just looking at your current revenue. They're also interested in the sustainability of your business. How strong is your client base? Are clients returning? Are you attracting new ones? Vagaro's CRM features track client visit history, spending patterns, and even your rebooking rates. High client retention and a steady stream of new clients indicate a healthy, growing business, which makes you a more attractive borrower. Imagine being able to show a lender with concrete data that 80% of your clients rebook within 2 months, or that your average client lifetime value is steadily increasing. That's powerful information. Thirdly, marketing effectiveness and growth potential. Vagaro's marketing tools allow you to track the effectiveness of your promotions, email campaigns, and loyalty programs. If you can demonstrate to a lender that your marketing efforts are consistently bringing in new clients and increasing revenue, it shows strong growth potential. This isn't just about current numbers. It's about projecting future success, which is a key factor for lenders evaluating risk. Fourthly, operational efficiency. While not directly financial, the efficiency that Vagaro brings to your operations can indirectly influence a lender's perception of your business. A well-managed, organized business that leverages technology for appointments, inventory, and staff management is seen as more professional and less risky. Lenders understand that efficient operations lead to better financial outcomes. So, while Vagaro isn't handing out checks, it acts as a powerful data hub that strengthens your position when you approach traditional lenders or alternative financing solutions. Think of it as your virtual chief financial officer, quietly gathering and organizing all the information you'll need. Now, let's talk about what options are available if you're a Vagaro user looking for funding. You'll be looking at the same avenues as any other small business owner. Traditional bank loans. These are often the most affordable, but also the most stringent in their requirements. They typically offer lower interest rates and longer repayment terms. You'll need a solid business plan, strong credit history, both personal and business, and often collateral. SBA loans, backed by the Small Business Administration. These loans are offered through banks but have government guarantees, making them less risky for lenders. They often have more flexible terms and lower down payments, specifically designed to help small businesses. Online lenders. The landscape of online lending has exploded in recent years. These lenders often have faster application processes and less strict requirements than traditional banks. However, they may come with higher interest rates and shorter repayment periods. Companies like OnDeck, Cabbage, now part of American Express, or Funding Circle are examples. Merchant cash advances, MCAs. While not technically a loan, an MCA provides an upfront sum of cash in exchange for a percentage of your future debit and credit card sales. These are often easier to qualify for, especially if you have high credit card sales, but they can be very expensive in terms of the effective annual percentage rate, APR. Lines of credit. Similar to a credit card for your business, a line of credit provides access to a revolving pool of funds up to a certain limit. You only pay interest on the amount you draw, making it flexible for managing cash flow fluctuations or unexpected expenses. With that said, thanks for watching, and until next time.